Ever feel like real estate investing is only for the wealthy? Today, I'm going to show you how you can start investing in real estate even if you're on a tight budget. Stick around until the end, because I'll reveal a special strategy that can help you get started with just a few $1,000s. This is the Next Millionaire Channel, your premier source for personal finance and wealth-building wisdom. So, let's dive into this insightful content. 1. Understanding real estate investing. Let's break down what real estate investing really is. At its core, real estate investing involves buying property to generate income or profit. The most straightforward way to do this is through rental properties, where tenants pay you rent that covers your mortgage and other expenses, potentially leaving you with a profit. Imagine owning a small apartment. You rent it out, and the rent covers your mortgage payments. Over time, as the property appreciates in value, your equity grows. That's real estate investing in action. But it's not just about rentals. You can also invest in properties to flip, buying low, renovating, and selling high for a profit. Or you can venture into commercial real estate, which includes office spaces, retail outlets, and industrial properties. Understanding these different types of real estate investments can help you choose the best strategy for your financial goals and budget. 2. The basics of rental properties. Rental properties are a fantastic starting point, especially for beginners. The process is relatively simple. First step, purchase a property. Second step, rent it out to tenants. Third step, use the rental income to cover your expenses, including the mortgage. Suppose you buy a property for $300,000 with a $30,000 down payment. With a 30-year mortgage at 4% interest, your monthly payment is about $1,432. If you can rent the property for $1,800, you're covering your mortgage and gradually building equity. Of course, you need to consider other costs like property taxes, insurance, maintenance, and potential vacancies. These factors will affect your cash flow, so it's essential to calculate them carefully. 3. Financial fundamentals. Understanding the financial basics is crucial for successful real estate investing. For example, with a $30,000 down payment on a $300,000 property and a 4% mortgage, your monthly expenses could be around $1,939. If you rent out the property for $2,000 per month, you break even or make a small profit. Plus, the property is likely to appreciate over time. Let's talk about appreciation. Over 30 years, a $300,000 property appreciating at an average rate of 3% per year could be worth around $973,000. That's nearly triple the original value, illustrating the power of real estate as a wealth-building tool. Additionally, don't forget the tax benefits. Mortgage interest, property taxes, and certain expenses can be deducted from your taxable income, effectively increasing your return on investment. 4. Leveraging your investment. Leverage is one of the most powerful tools in real estate investing. When you use borrowed money to finance your investment, you can control a large asset with relatively little capital. Your $30,000 down payment gives you control over a $300,000 property. As the property appreciates, you benefit from the increase in value of the entire property, not just your initial investment. For instance, if your property appreciates by 3% per year, that's a $9,000 annual increase on a $300,000 property. Over time, these gains can add up significantly, amplifying your returns. However, remember that leverage also increases your risk. If the property value drops, or if you're unable to make your mortgage payments, you could lose your investment. That's why it's essential to have a solid financial plan and emergency funds in place to manage these risks. 5. Inflation and long-term value. Real estate is an excellent hedge against inflation. As prices rise, so does the value of your property and the rent you can charge. This ensures that your investment keeps pace with or even exceeds inflation, protecting your wealth over the long term. Picture this. 30 years from now, you have a property that's fully paid off and worth nearly $1 million. That's financial security in a nutshell. Moreover, rental income typically increases with inflation, providing you with a growing income stream over time. This makes real estate a reliable source of passive income, even as living costs increase. 6. Real estate versus stock market. How does real estate stack up against the stock market? While the stock market can offer high returns, it's also more volatile. Real estate, on the other hand, provides steady cash flow and long-term appreciation, especially when leveraged. Investing $30,000 in the stock market might yield significant returns, but with higher risk. Real estate offers a tangible asset that generates income and appreciates over time. Real estate investments are less liquid than stocks, meaning you can't sell them as quickly. However, this illiquidity can also lead to less emotional buying and selling, helping investors stay the course and realize long-term gains. 7. Essential tips for real estate investors. Now let's dive into some essential tips to set you up for success in real estate investing. A. Use an LLC. Consider using an LLC for your real estate investments. This provides liability protection, safeguarding your personal assets in case of legal issues. An LLC also allows for more flexible tax treatment, potentially lowering your tax burden. Consult with a legal professional to set up your LLC correctly. B. Get landlord insurance. Landlord insurance is a must. It covers property damage, liability, and loss of rental income, giving you peace of mind. This insurance can also cover legal fees if you need to evict a tenant or face other legal issues. Make sure you understand what your policy covers and shop around for the best rates. C. Screen tenants. Carefully. Screening tenants is crucial. Conduct thorough background and credit checks to ensure reliable tenants who will pay rent on time and take care of your property. Check references and verify employment to ensure they have a stable income. A good tenant can make your investment profitable, while a bad tenant can cause significant headaches and financial loss. D. Consider property management. If you don't want to handle the day-to-day management, consider hiring a property management company. They'll handle tenant issues, maintenance, and rent collection for a fee, saving you time and stress. A good property manager can also help you maximize your rental income and keep your property in excellent condition. This is especially useful if you own multiple properties or live far from your investment. Act quickly with bad tenants. If you encounter problematic tenants, act swiftly. Address issues early to prevent them from escalating, which could save you time and money. Have clear policies in place for late payments and lease violations. Communicate regularly with your tenants and document all interactions to protect yourself legally. F. Handle security deposits properly. Follow local laws for handling security deposits. This protects you from legal trouble and ensures you can cover damages when tenants move out. Return the deposit promptly after the tenant leaves, deducting only for legitimate damages beyond normal wear and tear. Clear communication and documentation can help avoid disputes. A. Find a good deal. Finding a good deal is essential. Look for properties that are priced below market value or need minor renovations. Use tools like Zillow, Redfin, and local real estate listings to find deals. Network with real estate agents, attend auctions, and consider off-market properties. Being patient and doing thorough research can lead to finding excellent investment opportunities. H. Build good credit. A good credit score helps you secure favorable loan terms, reducing your mortgage costs. Pay your bills on time, keep credit card balances low, and check your credit report regularly. Consider working with a financial advisor to improve your credit score and explore different financing options. Good credit can save you thousands of dollars over the life of your mortgage. Get a plan for selling. Have an exit strategy. Whether you plan to hold the property long-term or sell after a few years, know your goals and the market conditions that will influence your decision. Consider the tax implications of selling and whether a 1031 exchange, which allows you to defer capital gains taxes by reinvesting in a new property, might be beneficial. Planning ahead ensures you make the best financial decisions when it's time to sell. Quick quiz time. What is the primary benefit of using leverage in real estate investing? Is it A, reducing risk, B, increasing potential returns, or C, simplifying property management? Drop your answer in the comments below. I'll reveal the correct answer at the end of the video. Let's dive into that bonus tip I promised you. Imagine this scenario. You've just bought a small multi-unit property, a triplex, let's say. You move into one of the units, making it your new home. The other 2 units, you rent them out. Here's where the magic happens. Let's break it down step by step. Step 1. Find the right property. Look for a multi-unit property that fits your budget. Let's say you find a triplex for $300,000. You've done your homework and secured a mortgage with a 5% down payment, which comes out to $15,000. Your mortgage, including property taxes and insurance, might be around $1,800 per month. Step 2. Move in and rent out the other units. You decide to live in one unit and rent out the other 2. Let's say each unit rents for $1,000 per month. That's $2,000 in rental income. Step 3. Calculate the financials. With $2,000 coming in every month and your mortgage at $1,800, your rental income covers your mortgage and you're living practically rent-free. In fact, you're making a small profit of $200 every month, which you can reinvest or save for future expenses. Step 4. Build equity over time. As you continue to pay down the mortgage, you're building equity in the property. Plus, if the property value increases by 3% annually, in 5 years, your $300,000 property could be worth around $347,000. Not only have you lived for free, but you've also gained $47,000 in property value and built up equity with every mortgage payment. Step 5. Plan for the future. As your equity grows, you might consider refinancing to pull out some cash for your next investment, or even selling the property for a profit. Alternatively, you could continue renting out all the units, generating more passive income once you move out. This strategy, known as house hacking, is a powerful way to jumpstart your real estate portfolio. It allows you to live at a reduced cost, build equity, and gain experience as a landlord, all without needing a massive upfront investment. House hacking isn't just a tip. It's a strategy that, when applied correctly, can set you on the path to financial freedom. With patience and smart management, this approach can transform your financial future, helping you build wealth while minimizing risk. Now, for the quiz answer. The primary benefit of using leverage in real estate investing is B, increasing potential returns. By using borrowed money to finance your investment, you can amplify your returns as you control a larger asset with a smaller initial investment. However, remember that leverage also increases risk, so it's crucial to manage it wisely. If you found this video helpful, please give it a thumbs up, share it with friends who might benefit, and subscribe for more insights on personal finance and wealth building. So that's it, folks. Stay focused, stay motivated, and keep pushing forward. The next millionaire is you.